So, you want to earn passive income with your crypto. You've basically got two main paths. One is stable and predictable, kind of like a savings account. The other is the Wild West, a chaotic, high-stakes world that promises much higher returns. So, which one actually builds more wealth? We're going to cut through the confusing jargon and directly compare the world of staking against the high-reward chaos of yield farming to find out which strategy is right for you. Let's be real. The crypto industry is an overwhelming mess of buzzwords with fuzzy, overlapping meanings. You hear about people making incredible returns, but you also hear the horror stories of people losing everything. The biggest pain point for most of us is this: you want to put your crypto to work, but you're terrified of the complexity and the risk of making one wrong move. Today, we're going to demystify the two most popular options and give you a clear, jargon-free explanation that lets you decide. Alright, let's start with the first path, staking. At its core, staking is just a way of earning rewards for helping to secure a blockchain network. Think of it like earning interest in a high-yield savings account. By depositing and locking up your crypto, you help the blockchain function, and in return, it gives you a cut of the profits. Many of the biggest names you know, like Ethereum, Solana, and Cardano, have all adopted a system called Proof of Stake, or POS. With POS, instead of using massive amounts of electricity and computing power to validate transactions like Bitcoin does, the network relies on users who lock up their coins as collateral. These users, called validators, are then chosen to create new blocks and confirm transactions based on how many coins they have staked. By doing this, they're literally proving they have a stake in the network's success. If they play by the rules, they earn rewards. If they act maliciously, they risk having a portion of their staked funds slashed, basically taken away as a penalty. So, what kind of returns are we actually talking about? For a huge network like Ethereum, you can typically expect an annual percentage yield, or APY, of around 2.5% to 4%. Other networks like Polkadot might offer returns around 4 to 7%, while Cardano often sits in the 3 to 5% range. These rewards are paid out in the network's native token. So, if you stake Ethereum, you earn more Ethereum. Simple as that. The beauty of staking really lies in its simplicity. You only need a single token to get started. For most people, the easiest way in is through a centralized exchange, like Coinbase or Kraken, which handle all the technical stuff for you and often have no minimum deposit. Or, you can go with a decentralized option like a liquid staking protocol. A platform like Lido, for instance, lets you stake your Ethereum and gives you a new token called Steth in return. This token represents your staked ETH but remains liquid, so you can still use it in other crypto apps while earning staking rewards in the background. It's a fantastic innovation, though it's worth noting that Lido's dominance has sparked some serious debate about centralization risks, which is a hot topic right now. So, why would you choose staking? The advantages are pretty compelling, especially if you're new to crypto or just prefer a more conservative approach. First off, it's just plain simple. Once you've delegated your coins or used a staking service, there's very little to manage. You can pretty much set it and forget it, and watch your crypto balance slowly and predictably grow. The second huge pro is the relatively low risk. Compared to other ways of earning in crypto, staking is considered one of the safest. Your main risks are the price of your token going down and the small chance of slashing if your validator messes up. But you aren't exposed to the scarier, more complex risks we're about to get into. However, staking isn't perfect. The most obvious drawback is that the returns are pretty modest. A 3% APY is great, but it's not going to buy you a Lambo overnight, and it pales in comparison to the triple-digit yields you see advertised in yield farming. Another major downside can be lockup periods. Some networks require you to lock your tokens for a set amount of time, meaning you can't sell them, even if the market is taking a nosedive. While things like the liquid STETH token help solve this, it's definitely something you have to factor in. Your funds might not be there the moment you need them. Now, let's wade into the Wild West of crypto. Yield farming. If staking is a savings account, yield farming is like being a landlord for your crypto in a chaotic boomtown where the rent can be astronomical, but so can the odds of your building collapsing. At its heart, yield farming is the process of providing liquidity to a decentralized finance (DeFi) protocol. Most of the time, this happens on a decentralized exchange, or DEX, like Uniswap or PancakeSwap. These platforms let people trade crypto without a middleman, but to do that, they need a huge pot of tokens for traders to swap between. That's where you, the yield farmer, come in. Unlike staking, where you just need one token, yield farming usually requires you to deposit a pair of tokens into what's called a liquidity pool. For example, you might provide an equal dollar value of Ethereum and the stablecoin USDC into an ETH USDC pool. In return for lending your assets, the protocol gives you a receipt, known as a liquidity provider, LP token, which proves you own a share of that pool. So where does the insane yield come from? It's a mix of things. First, you earn a percentage of the trading fees every time someone uses your pool. But second, and this is where the crazy returns kick in, many protocols offer extra incentives. They'll reward you with their own governance tokens just for providing liquidity. So, PancakeSwap might pay you in its cake token. You can then sell those reward tokens, or, in a process called compounding, stake them to earn even more rewards. The single biggest pro of yield farming is obvious: the potential for absolutely mind-blowing returns. In a bull market, when everyone is trading and new tokens are launching, yield farming can massively outperform staking. For aggressive investors who are willing to embrace serious risk, it offers a chance to compound your money at a speed that staking just can't match. However, the price of admission to this high-reward world is a long and frankly terrifying list of cons. You have to understand these risks. The most important one is called impermanent loss. This is a non-negotiable concept. Impermanent loss happens when the prices of the two tokens you deposited drift apart. Let's say you're in that ETH USDC pool. If the price of ETH skyrockets, the pool automatically sells some of your ETH for USDC to keep the value balanced. If you were to pull your money out right then, you'd get back less ETH and more USDC than you started with. Sure, you might have more in dollar terms, but you would have made even more money by just holding on to your original ETH. The loss is the opportunity cost compared to just holding. It only becomes a permanent real loss the moment you withdraw from the pool. Beyond that, you have smart contract risk. DeFi protocols are just code, and code can have bugs that get exploited. We've seen countless pools drained by hackers, with users losing everything. Then you've got straight-up theft. Rug pulls, where shady developers launch a project with tempting APYs, wait for people to pile in and then vanish with all the money. Finally, yield farming is a part-time job. It requires active management. APYs change by the minute, so you constantly need to monitor your positions, decide when to harvest your rewards, and figure out if it's time to jump to a new pool, all while paying transaction fees that can eat into your profits, especially on Ethereum. It is anything but passive. Alright, let's put them side by side for the final showdown. First up, their purpose. Staking is all about securing the network. You're helping to keep a blockchain safe and running. Yield farming is all about providing liquidity. You're acting as a market maker so people can trade easily. Next, the risk. Staking is low risk. Your main worries are the price of your token dipping and a small chance of slashing. Yield farming is high risk. You're juggling impermanent loss, smart contract hacks, and rug pulls, all on top of normal price volatility. Then, the rewards. Staking offers lower, more stable and predictable returns, usually in the single digits. Yield farming dangles the promise of much higher APYs, often in the triple digits, but they are wildly unpredictable and can vanish in an instant. Let's talk complexity. Staking is simple. It's largely a set-it-and-forget-it strategy. Yield farming is highly complex. It demands active monitoring, a deep understanding of its risks, and constant adjustments. Finally, liquidity. With staking, your crypto is often locked up for a period, though liquid staking is changing that. With yield farming, your funds are technically available anytime, but because of impermanent loss, withdrawing at the wrong moment could mean locking in a painful loss. So, after all that, which one is it? Where will you make more crypto? The honest answer is, it completely depends on. There is no single better option. For the beginner, the conservative investor, or anyone who values their time and peace of mind, the answer is clear. Start with staking. It's the safest, simplest way to start earning passive income. The returns are predictable and the risks are manageable. You can get your feet wet on a major exchange or explore liquid staking. For the advanced user, the risk taker, and the active manager, yield farming offers a path to potentially much greater returns. If you have the time for deep research, the knowledge to navigate risks like impermanent loss, and you're only using money you're truly prepared to lose, then yield farming can be a powerful tool. A good place to experiment is with stablecoin pairs on established platforms like Uniswap, which minimizes the risk of impermanent loss. Of course, this isn't an all-or-nothing decision. A smart strategy for many is a hybrid approach. You could put the majority of your portfolio in safer, stable staking as your foundation. Then, take a smaller, speculative slice and dedicate it to higher risk, higher reward yield farming. This lets you chase some of that explosive growth while keeping the core of your investment secure. The choice between staking and yield farming is a classic risk versus reward dilemma. Staking is for those who want safer, simpler, and more stable growth. It's a strategy that builds wealth slowly and steadily. Yield farming, on the other hand, is for those who want to provide liquidity to the DeFi world and chase explosive returns, but it comes at the price of massive complexity and much higher risk. There is no 100% safe passive income in crypto. The key is to understand the trade-offs. Match your strategy to your personal risk tolerance, and never, ever invest more than you are willing to lose. I hope this breakdown helped clear up the confusion. Let me know what you think down in the comments. Are you staking, yield farming, or both? What has your experience been like? Thanks for watching, don't forget to subscribe, and I'll see you in the next one.